quick chance to have a look through the slides already and have got the slides in front of you, of course, you can see the presentation in front of us as well. Please feel free to pitch in with questions. The best way to do that is in the chat box that hopefully you can see. I will, though, sort of answer all questions at the end of the presentation, but feel free to chip away with any questions that you may have, be it on the presentation itself or wider economic issues. So you can see that from the title of this presentation, I tend to focus on the upcoming election. Of course, that hasn't been yet fully confirmed, but I think it's a good, the most likely scenario to pan out over the next few months. And at the moment, I think it's very clear that the economy, is stuck in a bit of a rut, and a lot will depend on the outcome of any election and its implications for Brexit. So at the start, I'll just take you through a few charts showing you how clearly the UK economy has been adversely affected by all the Brexit risk and how that effect has intensified in the last few months, and then take a close look at the latest polling evidence to try and ascertain who's likely to win this upcoming election. So, as I said at the start, an election isn't 100% guaranteed. There are a couple of ways in which we might not actually see an election in the next few months. But I think both of those scenarios are highly unlikely to play out. The first way in which you could potentially see an election being delayed for several months is if Boris Johnson's proposals which he's outlined of putting to the EU today are actually approved broadly by the EU. A deal is agreed at the October summit later this month, and a deal gets through Parliament at the very end of this month. But I think the EU is not going to be agreeing to any of Mr. Johnson's new proposals. Without going into the nitty-gritty, you can read today's Monitor for that. It's likely that the EU will simply rule out his proposals out of hand because it creates still quite a leaky border and would seriously undermine the economy in the Republic of Ireland by potentially opening up avenues for fraud and for VAT and the incorrect levels of customs to be levied at the border, and so for the economy to be competitively undermined by a Northern Irish economy where those tax rates were a lot lower. In addition, I don't see the EU really being in a tactical position right now to think it's a good idea to deal with a UK government that simply doesn't have a majority and can't really promise to get any deal through Parliament. They may as well wait to see how the election pans out, and then if Mr. Johnson still is in power at that point, then seriously consider compromises. Or otherwise they'll be dealing with a Jeremy Corbyn-led government, which would implement a softer form of Brexit, which I think is still their preferred case. So I really doubt that the EU is going to be making significant compromises over the next couple of weeks in the run-up to the EU summit, and therefore will be in a position where there's no deal on the table, but the Benn Act will then be coming into effect. Now, it's still hard to say whether Boris Johnson really is going to follow through on his commitment not to write that letter and therefore sort of break the law and be forced out as Prime Minister through a no confidence vote, or whether he'll just grit his teeth and actually send the letter. I don't think that really matters, though, either way for whether we'll see a general election happen in the fourth quarter of this year, because in the event that, say, he's forced out of office in a no confidence vote and there's a government of national unity formed, it will really only last just to post that letter. I don't see that unity government surviving for more than a few days, because there are so many disparate views within that potential new government on the long-term form of Brexit, to mean that that government couldn't then go forwards and hold negotiations with the EU. Of course, this government of national unity would depend on votes from former Tory MPs, Labour MPs, SNP MPs, and Lib Dem MPs, and all of those different parties have somewhat different stances on Brexit and what they want to get out of it in the long run. So I think the only thing they agree on is that a no-deal Brexit would be a disaster. So once the letter is posted, I think we'd see pretty quickly that the government would then call the general election and would then be going into that campaign. So regardless of who is the Prime Minister after October the 19th, when the letter has to be sent, I don't think that really changes the chances of a general election. The Conservatives want one, and Labour think they have a good chance of winning the election too. So given that you normally have to have about a 6-week period between parliamentarians actually voting for a general election and actually taking place, I think we're looking at a general election in mid-December. By law, you need a 5-week period for campaigning between when Parliament dissolves and the actual polling day. And then there's also usually a period of around a week where Parliament just finishes off unfinished business before it disbands. So given that, and I'm assuming that we'll see a vote for a general election occur in late October, and then the election actually being held in early to mid-December. And in previous elections in 2010, 2015, even 2017, it's been possible to argue that the sort of outlook for the economy didn't really depend that much on the election result. Increasingly, we see very little difference as well at the moment between the Conservatives and Labour in terms of fiscal policy. And that gap has generally been narrowing since the 2010 election. But this time, I think things are very different, given that the parties have very clear and very different Brexit stances now. In the event of a Tory majority, you could quite clearly see a shift to a no-deal Brexit, given that the Boris Johnson's proposals right now are probably the most he's willing to compromise, and whereas Theresa May was hamstrung by a small Tory majority in the first quarter of this year in trying to get the original Brexit deal through. It's possible that Tory majority may consist of many more MPs that are willing to go for no deal, given that the Remainers have been sort of purged from the party, with 20 of them leaving early in September. Many of those have decided not to stand again, and many of those will be contesting their seats and may struggle to hold on to them. So if it is a Tory majority, it will be a more pro-Brexit Tory majority, and therefore the chances of actually following through with a no deal and there not being a sort of blocking majority in the Commons to prevent that are much greater. Alternatively, if it's a Labour-led coalition, so it's quite possible that Labour could be in some form of formal agreements with the SNP or the Liberal Democrats after the next general election, then you could be looking at either no Brexit or a soft Brexit. So Labour's formal policy on Brexit at the moment is to negotiate a better, softer deal with the EU and then put that to a referendum with Remain being the other option. Now, of course, that process would take 6 to 9 months, but I think you'd immediately see some recovery in business confidence and sterling would rebound. And so you'd start to see some of the benefits of that shift in the government's Brexit stance come through immediately at the start of next year. And then finally, the other sort of main option to consider really is another hung parliament, where it may be that the Tories are in alliance with the DUP again, or there's just only a couple of votes in it and every vote goes down to the knife edge. But in that sort of environment, I think the most likely outcome is further rolling extensions of the UK's EU membership, and just the continual uncertainty that is weighing down the economy this year persisting well into 2020. Just to run you through some of the economic impact of the uncertainty of the last couple of years, I mean, it's very clear that sterling has been greatly depressed by Brexit, and whatever result that we get from the general election and the Brexit path that we then follow really will have a massive impact on sterling and hence on consumers' living standards and their real wages. So chart 2 here tries to get to an estimate of how large the sort of Brexit risk premium that is currently weighing down sterling might be. Now, a bit of a caveat initially with this chart, because it depends on a relationship between sterling and interest rate expectations that was incredibly close between 2010 and 2016, but now may not fully hold were Brexit risk to fully go away. So you can see the first year of this chart, between 2015 and 2016, there was this very tight relationship between interest rate expectations and the level of sterling. There was no risk premium at all attached to the exchange rate. And if I took this chart all the way back to 2010, you just see the two lines moving in complete lockstep. But as we went through 2016, sterling depreciated much further than you would have expected given the movement in interest rate expectations in the UK and in other major economies. And then, so this gap can really be seen, the gap between the blue and the black line can really be seen as a general estimate of how concerned markets are about the damage that Brexit might do. And you can see the gap has kind of varied and increased at various times, and has really blown out this year when we've hit sort of peak Brexit uncertainty, many options in play, and no deal Brexit risk being quite high generally because the UK government is more willing, it seems, to take on that option. At the moment, therefore, it looks as if sterling is about 15% below the sort of level it would be if there were no Brexit risk at all. Now, I don't want to place too much weight on that sort of 15% risk premium right now, because we're now more than 3 years on from when this past relationship was very strong between interest rate expectations and sterling. And even in the best possible case where, say, for the economy and for sterling, where Brexit didn't happen, was cancelled altogether, you might not get sterling go all the way up to 15%, a 15% rise, because it depends on the wider political environment in which that happened as well. It could be that it's a Corbyn-led government that would be implementing that policy, in which case there are a whole set of other concerns that investors might have that would be weighing down sterling. But at the moment, it seems like that risk premium is about 15%. And that's coinciding with around a sort of 35 to 40% chance of a no-deal Brexit being factored in by markets at the moment. That's certainly the sort of steer you get from betting markets, showing quite a high probability of a no-deal Brexit at some point, not necessarily in October because of the Benn Act, but looking ahead further to January, there's certainly a high probability seen at that point. So therefore, that's that 15% risk premiums with a 40% probability of a no-deal Brexit. If that was suddenly to go to 100% no-deal Brexit actually being implemented, then you could easily see sterling getting down to 105 against the US dollar, in which case that points to a lot of inflation pain to come for consumers, with inflation likely getting up to around 4%, even if the government decided in the short run to reduce tariffs on any imports that were coming in from the EU. The exact specifics will depend upon those the exact level of those tariffs and quite how far sterling depreciates, how much of it is passed on to consumers. But it's perfectly plausible, looking at what happened in 2016, 2017, that inflation could be getting towards 4% about a year or so after a no-deal Brexit actually happening. And so that would imply another period of falling real wages and a real slowdown in consumption growth. Alternatively, if sterling did actually appreciate, then we have some benefits coming to consumers, with inflation probably hovering around 1% or so for a couple of years in the event of a Brexit being cancelled altogether, and say sterling recovering to the 140 level against the dollar that we saw pre the referendum. Meanwhile, it's certainly clear that consumers' confidence has been depressed by the whole Brexit saga. That's not to say that consumers overall are incredibly depressed, because there's a lot of other things for them to be positive about right now, given that the unemployment rate is at a 40-year low, wage growth has been picking up to 4%, and they're seeing big increases in their income tax thresholds, which is boosting their disposable incomes. But certainly confidence would be a lot higher were Brexit not rumbling on in the background. So this is just the GfK's consumer confidence survey, and data here go up to September. The blue line there is the composite index, so the overall level of consumer confidence. And as you can see, it's been sort of trending down over the last few years. But really what underneath the surface, what you can see is consumers are still very optimistic about the outlook for their own personal finances. They think they're in good shape, relatively low debt levels, positive income growth. And so as you can see by the green line there, their confidence levels in their personal financial situation are actually quite high. It's the assessment of the wider economic outlook that is keeping them miserable right now, and obviously that is predominantly reflecting Brexit concerns. And you can see that those concerns really intensified at the start of 2019, as it looked as if there might be very little chance of a Brexit deal going through, and a no-deal Brexit actually likely to happen at the end of March. And also immediately after the referendum, you saw a huge drop in consumer confidence. So you do tend to see when Brexit risk or no deal Brexit becomes more likely, then consumers become more depressed about that. Only around 25% of people are sort of happy with a no deal Brexit and don't think it will hurt the economy. The majority of people are worried about the risk that it could potentially pose to their living standards. So again, there's scope for a big divergence here, depending upon what the outcome of the general election actually is, with a huge recovery in confidence, certainly possible were Brexit to be scrapped. But if it's a no-deal Brexit, then a further decline from already fairly subdued levels. But it's not just consumption that is sensitive to what Brexit outcome finally happens next year, but obviously business investment has been sensitive to the Brexit saga too. As you can see in chart 4, business investment has been falling from around the end of 2017. It's now about 3% below its 2017 peak. Now, this isn't a severe downturn in business investment. I've shown this long run chart here to make the point that actually business investment is very, very volatile, and we have seen periods where business investment has been falling quite aggressively, say in the early 2000s, for instance, when the overall economy hasn't been in recession. So this certainly hasn't, the downturn in capex has not been as bad as perhaps most economists, including myself, would feared immediately after the referendum. The wider economic environment has actually been pretty conducive for firms pressing ahead with investment, given profit margins have been holding up pretty well. Cost of capital is very low, and in many sectors there are capacity constraints that are biting. But nonetheless, Brexit risk has again been placing some downward pressure on investment, and the UK completely missed out on what was a global upturn in capex that came through in 2017 and 2018. So again, there is quite a lot of scope for a rebound if there were to be a positive resolution to Brexit. Equally, you could certainly see very dramatic falls in business investments in the event of a no deal, given it's not uncommon for, as you can see in the past, for capex to fall by say 10% in a proper downturn. But just to show you how much scope there is for potentially for an upturn in capex, whether to be a Brexit deal finally getting through the Commons or no deal Brexit, or no Brexit at all. Chart 5 shows you that firms actually have a lot of excess cash on their balance sheets right now. So were there to be any news, they could really invest quite quickly. So the blue line here just shows you firms' currency cash deposits with banks that are denominated in sterling and held with the UK banks. So if you look at firms' overall balance sheets, they also include deposits that they hold in foreign currency terms or with non-UK banks. And those foreign currency deposits are shown by the black line there. Now, I think those foreign currency deposits shouldn't really be considered to be a source of a potential boost to investment were there to be positive Brexit news, because that cash is being purposely kept by firms abroad, so probably is designed to facilitate their the businesses that they have, their overseas operations, and the value of those cash holdings will go down immediately upon any sort of Brexit breakthrough, because sterling will appreciate, and so the sterling value of those assets will go down. So I don't think we should consider those foreign currency holdings as the source of a potential boost to the economy from a Brexit breakthrough. But certainly the blue line, which does show that there's an excess amount of corporate saving in sterling terms with UK banks, I think that is a source of extra cash that could potentially be spent in the event of a Brexit breakthrough. Now, that, as you can see there, I plotted a trend line there to show you, just to try and therefore ascertain how far above trend those cash savings might be. And as you can see, there's a figure of close to 1.5% of GDP. Now, that boost, the potential boost, would not come through overnight. That extra saving is being built up over a 3-year period, so it would probably be run down over a similarly long period. In addition, again, it depends upon the wider political context in which we actually get to a Brexit deal. If it's under a Corbyn government, then there are many other reasons why firms might be wanting to hold on to their cash right now. And more generally, the global environment has deteriorated as well, making firms perhaps more likely to hold on to cash right now, whilst there's still wider levels of global political uncertainty. Nonetheless, 1.5% of GDP is quite a significant sum of excess cash that could potentially be spent. And so I think in the event of a Brexit deal, some of that extra cash would be spent. We would start to see the capex numbers improve and improve quite quickly, given that this is cash already on the balance sheet. Firms aren't credit constrained. They could really go ahead with projects that they've just been sitting on for the last 12 months. Finally, I think there's also scope for an improvement in the UK's exporting performance in the event of a Brexit deal being signed, because it's been very clear over the last couple of years that uncertainty about the UK's long-term trading relationship with the EU has been dampening demand for UK exports. It's meant that supply chains that might have been created in the UK have not formed. And German manufacturers, for instance, have been very reluctant to source their components from a UK supplier, given the risk that in a no-deal Brexit that supply chain might break down, and that could disrupt your whole production process. So just to get an idea of how bad the UK's trade performance over the last couple of years has been, I think you can get an idea of that from chart 6 here, which shows you just net trade as a share of GDP. Now, net trade is actually a negative component of GDP because imports exceed exports. So that's why you can see most of the data here is negative. Now, it's important to look at net trade together with inventories and the acquisition of valuables component of GDP, because you often see offsetting movements in these components in any given quarter. So the blue line you can see there is just net trade. That's actually pretty volatile, and it just doesn't really give you an idea of the underlying picture. If you look at all those three components of GDP together, then I think you do see really how net trade has been impacted by the depreciation that we saw in 2016. Now, as you can see, the black line there is actually been deteriorating. So net trade has actually become an even more negative component of GDP, despite the fact that we had that 15% depreciation of the exchange rate in 2016. On the basis of all those other big depreciations that we've seen in the last 50 years, you should have seen net trade make a positive contribution to GDP growth and now be a slightly positive component of GDP. I've shown that by the green line there, which is just based on the experience we've seen of those past 4 big depreciations of sterling. That's what should have happened if the UK had followed, if it had just been a normal depreciation. But of course, sterling depreciated because there was a lot of uncertainty about Brexit, and that has really been the dominant influence on why UK exports have been very sluggish and why we've lost market share over the last couple of years. And you can see actually that's a pretty huge underperformance there, perhaps around now 2% of GDP gap between the path you would have expected net trade to go on and the path it's actually been. And I think most of that gap can be attributed to that Brexit uncertainty. So again, huge scope for divergence here if there's any resolution on the Brexit front. Although sterling likely would appreciate in the event of a Brexit deal being signed, the reduction of all that uncertainty really could provide a boost to the exporting sector and offset the damage from a stronger pound. So just to wrap up the sort of potential economic impact from any sort of Brexit resolution, chart 7 just shows you our forecasts for GDP in the 3 scenarios I outlined on the first slide. Now, our base case is that it's a hung parliament and we have rolling Brexit extensions. So there's another extension at the end of January. There's still a blocking majority towards a no-deal Brexit, and whatever government is in place right at that point also has to ask for another extension. And so the current fog of uncertainty continues deep into 2020, and therefore the economy remains pretty sluggish. So the green line there shows you our current forecasts for the economy. We do expect GDP growth to actually pick up a little bit in 2020. That's partly reflecting a looser fiscal stance. But also we think we might start to see some stabilization in business investment, given that the wider environment for investing is quite positive. There's only so long that firms can hold back from investment projects that look like they pay off a good return. And I think you might start to see some resilience in the corporate sector to the sort of levels of uncertainty. And if once we've had 3 Brexit extensions, I think people will become a bit more relaxed about impending deadlines again. So we do see a bit of an improvement in GDP growth coming in 2020 from those 2 sources, but only a marginal one. You can see growth is still only hovering between 1 and 1.5% in our central forecast. In the event that the UK actually managed to leave with a deal before the end of January, then I think you could certainly see that big rebound in capex come through, and a renewed fall in inflation would also boost households' disposable incomes. That would come through after about a year, given the time lags with movements between the exchange rate and those actually feeding through to consumers. So you're starting to see growth really pick up in the second half of 2020. And in that sort of scenario, with fiscal policy likely being loosened as well, you could see growth picking up to the 2% year-over-year rate, which would be putting pressure on the MPC to start hiking rates again. And then in the no-deal Brexit scenario, I mean, these numbers we advance with, relatively large uncertainty bands, because there's a lot of, there's not much clarity on what a no-deal Brexit actually would entail. But we think, clearly the economy would go into recession. In the short term, in the first couple of quarters, you'd see still considerable disruption simply with the supply of goods. But as you went further into 2020, you'd be starting to see the inflationary consequences for households, and you'd also really then be starting to see capex being cut at an aggressive rate. So if the greatest recession risk in our view actually is sort of further down the line as you go into late 2020, when when the inflation shock really will be hitting consumers quite hard. And in the event of no deal, there are a few deals for certain sectors actually that would probably keep the status quo sort of rolling over for 3 to 6 months. If you look at sort of like licenses for haulage companies and for airlines, they, for instance, maintain the status quo. Little deals in those sectors keep the status quo going in the event of no deal for 3 or 6 months, but then they sort of roll off as you go into 2020. So no deal Brexit could well be a series of sequential shocks hitting the economy rather than a sudden smash at the end of January and then a sort of recovery thereafter. So actually we don't see the economy pulling out of recession as far out as we forecast further towards the end of 2021. So that's a summary of our economic views. But as I mentioned earlier, we're assuming there that we actually get a hung parliament. That is not really what the current opinion polls suggest. But I'll come on to why we think the polls or public opinion could shift towards or away from the Conservatives during election campaign. So chart 8 shows you that Conservatives actually have a pretty healthy lead over Labour in the latest opinion polls. When Boris Johnson became Prime Minister, around 5% of people who had been backing the Brexit Party came back to the Conservatives, and they've pretty much stuck with them for the last 2 months, despite some of the setbacks in Parliament. So the Conservatives are now roughly on 32% in most opinion polls. Labour down at about 23-24%. And the Liberal Democrats have held on to the recovery and support that we saw a few months ago. And the Brexit Party have fallen back over the last couple of months in response to the Conservatives' renewed rise in support. And on the basis of past form, the sort of 8% or so lead that the Conservatives have over Labour usually would be just about big enough for a majority. I'll come on to how these vote shares might transpose into seat projections in a few minutes. But first of all, I think it's worth noting that there is a very big dispersion at the moment in what the different polling companies are saying. That 7 to 8% is the average right now of all the polls, but there are some saying it's a complete dead heat, and others showing the Conservatives miles ahead. And so I think it's just worth looking at why there is this big discrepancy right now, and then figuring out which polls are perhaps worth discounting. First of all, the Kantar poll there at the very top of chart 9, which shows a very big lead for the Conservatives. That does seem to be a product of the question that is specifically asked to voters. So when they're presented with the initial list of options, to different list of parties to pick from, the Brexit Party isn't one of the options that is immediately presented to voters. in all the other polls now, that is the case. The Brexit Party is considered popular enough to be on the sort of shortlist of parties that are presented to voters. And so in the Kantar poll, you consistently see the Conservatives having a stronger lead than in all the others. I think that is because of the structure of the poll there. Now, I think given that the Brexit Party intends to field candidates pretty much across the country, and likely will get its fair share of media attention during election campaign, it's reasonable to put them on that short list, and therefore the Kantar poll should probably be discounted from the range of plausible estimates. But it's more importantly at the other end that I think several of the polls should also be discounted or down-weighted. Those ones that show a very close lead at the moment, I think, are being distorted by this problem of voters not correctly reporting how they voted in 2017, and that is really messing up the weighting for some of these polls. So go back to 2017, there were 40% of people who voted for Labour. At the moment, only around 35% of people can actually remember that they voted Labour or recall that they voted Labour. And this really messes up the weighting. Basically, if you don't re-weight for that false recall, then you get too many Labour voters in your sample, or left-leaning voters in the sample, and therefore you present what is an artificially close race in your overall polling numbers. If you look at the Opinion and YouGov polls, and those are the two which show quite largely for the Conservatives, they are fully adjusting for this false recall problem, and they know it exists because they have kept the same sample of people on the books since 2017. So immediately after the election in 2017, they asked voters in their panel, how did you vote in the general election? And they immediately saw this false recall problem, and therefore been able to sort of reweight their survey to adjust for that. So those surveys that don't take much account or no account of that are the ones that are towards the bottom end of the range there and suggest that there's a very close race. So for that reason, therefore, I think we should perhaps exclude some of the ones that suggest it could be a very close race. Now, the polls were almost universally wrong in 2017, and they were wrong all in one particular direction, which was they underestimated support for Labour. So it's obviously worth asking, when Labour are well down in the opinion polls as well at the moment, whether the polls might be making that same mistake again. Now, the problem that the polls had was that they were using these turnout models to adjust their raw voting data. So rather than, as used to be the case, relying on voters' own reported likelihood to go out and vote, they sort of discounted that data and said that, well, if you're aged between 25 and 30, you're not very likely to actually turn out to vote. So whilst you say you're going to vote, we're going to downweight your response. And that had proven to be, a useful adjustment to make, say, for the 2015 general election, where turnout was quite low, particularly among the young, and the Conservatives won that election. So as you can see here in 2017, pretty much all the main polling companies underreported how well Labour would do because of this re-weighting problem. So you can see that the blue bars there are the sort of raw voting data that they actually received, and then the black bars there are what actually they reported having made these turnout adjustments, which proved to be inaccurate. Voters actually did vote how they said they were going to, or the young people who did say that they were likely to vote did actually turn out to vote. And so they should have gone with that self-reported likelihood of turnout rather than these model adjustments based on past behaviour. Now, all companies have been those turnout adjustments since the 2017 general election. So it's unlikely that we're going to be sort of caught out by that again. They're gone back to basing their polling estimates on self-reported likelihood to turn out. So rather than there actually being a bias, against Labour in opinion polls, there might be, in fact, an overstatement of how well they're doing. We get an idea of that from the European Parliament elections in June, where Labour actually underperformed considerably compared to what pollsters actually thought was going to happen. Obviously, that's only 4 or 5 months ago, so this is perhaps a more concerning area of potential bias. So as you can see here, Labour's vote underperformed by 5 percentage points. That was the biggest shortfall in support, potentially suggesting that the polls might be, which haven't adjusted their methodology since then, might be overstating how well Labour's going to do in the general election. So given those points, the fact that there's this false recall problem, that means we should probably exclude those polls showing a very tight race, and the fact that overall the polls do seem to have actually overstated how well Labour would do at the European Parliament elections, I think it's reasonable to suggest that the Conservatives are probably around 10 percentage points ahead, rather than that sort of 7% level, which is the average of all opinion polls right now. So if that did pan out, what would that 10% differential mean? Well, looking at chart 12, I've tried to come up with some different projections. So first of all, on the left-hand side, you just see the 2017 election result, where the Conservatives got 317 seats. Now, if you apply the swing in the national share of the vote from 2017 to the latest to the YouGov polls, which showed a sort of 10% lead for the Conservatives at present, then if you applied that swing to every single seat in the UK, regardless of its individual characteristics, then you get the uniform national swing projection in the middle of this chart 12, which shows you that the Conservatives would actually go up to 323 seats, because although their national vote share is down on 2017, it's not as down as far as it is for Labour. And whilst the Brexit Party has picked up to say 15% support, whereas UKIP was only in the 2 to 3% range in the 2017 general election, because of the first past the post system, they're not really going to be winning many seats. In fact, our UNS projection there in the middle of chart 12 shows they'd only be getting 2 seats. So that's just about enough for the Conservatives to actually get a majority. So 323 is just one above the figure that is probably needed for an outright majority. There are 650 MPs in the House of Commons, but Sinn Féin MPs do not take up their seats, and currently there are 7 of them. That number seems to be pretty stable over time. So that brings the threshold down that you need for an outright majority to 322 from what otherwise would have been 325. So a small gain to the Conservatives based on the sort of where we think public opinion currently is. Actually, the Conservatives might be on for a slightly bigger majority, because if you look at the regional data, which these polling companies do report, then the Conservatives are holding up better in the sort of marginal constituencies where they really could be taking seats off Labour. So if we just go on to chart 13, this just shows you the swing in from the 2017 general election for the different regions of the UK. So I've just shown the sort of main 5 regions of the UK here. Because if you start using polling evidence, which is broken down to the usual 12 regions of the UK, you get very small samples for those areas and quite a lot of volatility. YouGov actually reports its data just on the basis of a breakdown into 5 UK regions, and those still leave you with quite big samples and fairly stable results across polls. So if you look at chart 13, you can see that the Conservatives are down in every single region of the UK compared to 2017, losing about 7% support on average. But there's a really big difference across the different regions of the UK, with most of the biggest percentage losses right now are being seen in the south, which is where they traditionally have very large majorities. So even if they could see a swing against them around 15%, they could still hold on to the vast majority of seats in the south. Whereas they're holding up actually a bit better in the Midlands and particularly well in the north of the country. By contrast, Labour is actually really struggling in the Midlands and the north, given these latest opinion polls. In particular, the north, they've really lost a lot of support, and that could be leading, even though these are traditional Labour heartlands, you could be starting to see quite a few of those seats go towards the Tories. And it's really the Midlands that you have to focus on in general elections. That's where the largest number of marginal seats are. And this is where you can very clearly see Labour underperforming, and Conservatives actually holding on a lot better than Labour in that area. And so that's why when you apply these regional vote swings to the individual seats, then you actually see the Conservatives probably doing a bit better than the uniform national swing projections imply. So always bear this in mind over the next couple of months when you see sort of seat projections. If they're just based on the national polling data and don't take account of the regional picture, then they may well be underestimating support for the Tories. Because when you go beneath the bonnet and you look at the details of the regional details of the polls, you actually see the Conservatives holding up much better than Labour in the key marginal areas. And so when I crunch through all the regional data and then therefore forecast all the different seats on the basis of those regional swings, you actually see the Conservatives with a sort of 10 percentage point lead in the national polls coming out with, say, 338 seats, so 15 more than in that uniform national swing projection. And so that gives them a majority of more like 35 seats, which it could well be enough for a no-deal Brexit. So on the face of it, that's quite concerning for the economic outlook. If public opinion doesn't shift in the next 2 months, then we could be on course for a Conservative majority, which certainly would lead to a much greater chance of a no-deal Brexit actually happening. That said, I think there are some reassuring points to be made here too. For a start, if you look at the last general election, you saw a very big shift in public opinion happen during the election campaign. So things are certainly not set in stone. If you also go back to 2010 as well, there was a very big shift in public opinion during the campaigning period. So there's still plenty of scope for public opinion to move. That's not to say it's going to move in Labour's favour, but there are a couple of other factors that I think it may well do so. If you look at people who are replying to current opinion polls and say that they don't know how they're going to vote, that proportion is actually a bit higher than normal. Where even though it seems like everyone's Brexit views are set in stone, have become more and more entrenched. In fact, there is quite a large percentage of people, about 16 to 18% in most opinion polls, saying that they don't know how they're going to vote. That's more than usual, around 15%. But what's much more important is that the current people who say they don't know disproportionately voted for Labour in the 2017 general election. And to me, that suggests that they're more likely, therefore, to come back either to Labour or support a more progressive party. And therefore, that the Conservatives' poll lead might start to decline as these don't knows make up their mind. Now, on the basis of past elections, you tend to see the don't knows only starting to make up their mind in the last 2 weeks or so of the election campaign. So it could be quite a long time before you see this recovery and support for Labour actually come through. But nonetheless, given that split there, with much higher percentage of ex-Labour voters saying they don't know than for other parties, I think you could see a narrowing in the Conservatives' poll lead in the final couple of weeks of the election campaign, regardless of what else happens. And you only need a pretty small shift in support back to Labour to peg the Conservatives back down to the hung Parliament territory again. So chart 16 here just takes that regional projection that we saw earlier, where the Conservatives have had 338 seats. And then on the far right here, you can see what would happen if there was just a 2% shift in every seat, in every region of the UK in public support from the Conservatives to Labour, perhaps brought about by that last minute decline in don't know people. And on that basis, you can see the Conservatives coming back to 310 seats, which would be short of outright majority. They would probably be in some position to create the next government, perhaps with the DUP. But again, it would be a very fragile form of government, and there wouldn't be the majority that you need to actually force through a no-deal Brexit. And that's with only a very small shift in support from the Conservatives to Labour. So you can really see we're at the point where very small shifts in public opinion can have a big impact on what Brexit outcome we finally get. And then I think it's also reasonable to expect that if we do get beyond the October 31st deadline for Brexit without a deal and without having actually left the EU, then the Conservatives will take some of the responsibility for that. and you'll see a renewed shift in support back to the Brexit Party, which again could be damaging for their chances. So if you see a 5% shift in support from the Conservatives to the Brexit Party, so pretty much all of those voters who came back on side when Johnson took over, then returning to the Brexit Party on current opinion polls, with that shift then added on, you would see the Conservatives back down to 300, which again would leave actually Labour in the position to form the next government in coalition with some of the other parties. So it's perfectly plausible. I think we see either or both of those shifts happen to some extent, and therefore to erode the Conservatives' poll lead. And finally, I'd just like to stand back from the polling evidence and just take a look at consumer confidence, which often has been actually a better indicator to how the government of the day is going to perform in a general election than opinion polls. And as you can see in chart 17 here, consumer confidence is actually a bit below the levels you'd normally tend to see when a government is going to be re-elected with a majority. Confidence is actually a bit lower as well than it was in 2017, suggesting that voters may not be giving the incumbent government much credit for the current situation. And it was actually consumer confidence was a particularly good guide to the 2017 general election, when all those polls were suggesting initially that there was a sort of 20 percentage point lead for the Conservatives, but actually confidence was at the levels that you usually see when it was a hung parliament. And so, given that we're actually a bit lower on confidence levels than we were back in 2017, that's not really an encouraging thing for the Conservatives. So to sum up then, our assessment is that if there's an election today, the Conservatives would probably get a small majority, but public opinion is likely to shift a bit against the Conservatives over the next couple of months, because those don't-knows will make up their mind, and because when we get beyond the October deadline, the Brexit Party will likely pick up again. And so our base case, advanced with fairly low probability at the moment, is that we have a hung parliament, the Conservatives in a minority government, but not having the majority to push through any one particular course of Brexit action. So it's really just a continuation of the status quo and the uncertainty that we experience right now persisting. But as you can see on this final table on chart 18, I've given that hung parliament a 35% probability for now. I don't think you can go higher than that, given that public opinion has been quite volatile in the last couple of elections. And we've also seen very big swings in voter sentiments earlier this year with the local and European Parliament elections. So voters just don't seem to have the sort of loyalty that they have had in the past. And also, of course, those don't-knows are unusually high right now. So you still have to give quite a large probability to all the other outcomes that are featured on this page, with the next likeliest outcome, I think, being that Conservative majority, which would certainly increase the chances of no deal. Wouldn't make it inevitable. Could still see the UK and EU governments coming closer together for a deal, particularly if then a no-deal Brexit really is seriously threatened. But nonetheless, I think it would be then 50-50 between a deal and no deal in the event of a Conservative majority. And therefore, you see sterling weaker and potentially some impacts on the MPC as well. So I won't run through all the details on chart 18 with all the other possible outcomes and sort of market and MPC impacts. But if you have any specific questions, please fire right now. If you'd like to send in a question, you should see there's a chat box on the bottom right. If it's set up as it usually is, then that should be an anonymous question, so I'll see it and I won't mention who it is. So if you want to remain anonymous, you can still pitch in with a question. Okay, so I've had a few questions in already. One question about how the MPC might potentially get through the next couple of months with all this political uncertainty rumbling on. It was clear in the minutes of the most recent meeting in mid-September that the MPC is starting to think it might need to cut interest rates in the event of just the status quo continuing and the uncertainty persisting. And they're pretty bearish on the near-term outlook for the economy. So they're only expecting GDP to rise by 0.2% quarter on quarter in Q3. If that were to come to pass, we saw weaker figures, then the case for easing would strengthen. But it's certainly not our base case. We actually see Q3 GDP surprising their expectations to the upside. Our forecast currently is 0.3%. But also, looking into 2020, as I said, that you have these serious potential for upside were there to be a Brexit breakthrough. Regardless of what happens, we're likely to see looser fiscal policy, and so the MPC, with its view that the economy is working at its potential supply level, will assume that fiscal easing will be potentially putting the economy into a state of excess demand and that creating inflation pressure. But also, there's already monetary stimulus in train. If the MPC just keeps interest rates on hold, effectively monetary policy will be becoming looser because the existing stock of mortgages can be refinanced at ever lower interest rates. So that's what we're continuing to see at the moment. And my projections for mortgage rates next year suggest that we could be seeing a refinancing boost to households' disposable incomes of nearly 0.2 percentage points. So the boost is from that refinancing process of refinancing those old fixed rate mortgages at lower interest rates is going to be kicking in again. And so, given that policy support already in train, and the fact that actually the economy still hasn't slowed to a sort of below trend rate yet, I think we'll be pressuring the MPC to be very cautious. They already think monetary policy is in a very loose position. Inflation pressure is very visible, although the headline rate of inflation is just a bit below the 2% target at the moment. Wage growth is up at 4%. The labour market is tight. Yeah, although some surveys suggest that we might be starting to see employment growth fade soon. I think again they'll want to be cautious and wait to see it actually come through in the data. So I think it's more thumb twiddling for the MPC for the next couple of months. They will just be. I think they can afford to wait and not rush to proceed with extra stimulus. That's certainly been the pattern that we've seen this year when other central banks have obviously been pressing ahead with stimulus, and the MPC has been pretty resolute in saying actually we don't need extra rate cuts, and until growth really deviates well below trend, I think they will be cautious. At the moment, the latest rate of year-over-year GDP growth is 1.3% for Q2, and that's when we saw the growth rate depressed by an unwind of stock building. So given the MPC's estimate of trend growth is a bit below 1.5%, we still haven't seen yet any meaningful spare capacity open up, even though we've had nearly a year-long period now of uncertainty. I've been asked about the possibility of a Farage-Johnson alliance and whether that would make a no-deal exit more likely. I mean, if we did have to see that alliance, it certainly would make no deal very likely. As I showed you on the previous slide, the how well the Conservatives do does really depend upon how much the Brexit Party vote share they grab in the Midlands and the North, where they're actually doing quite well. So if there was a formal alliance, then they could really knock out Labour, I think, in the Midlands of the North, and you'd see quite a large no-deal Brexit bloc in the Commons. But the problem is that the Prime Minister has rejected this potential pact already. It would actually anger the moderates in the Conservative Party who don't want to be campaigning on a no-deal Brexit platform, and that's the price that Farage has placed on actually having this pact, and that's I think a too high a price for Conservatives to pay. I have to take. I think Boris said his word when he says he would actually prefer a deal. And that explains why he's already refused to entertain such a pact with Mr. Farage. But more importantly, there are around 100 Conservative MPs who are a member of the One Nation caucus who, generally, strongly favour leaving with a deal. I think would be, a block to the Prime Minister on any such move. So if we did see that alliance, then I think it would be very likely that therefore we'd see a big majority for the Conservatives and the Brexit Party together. But I think it's unlikely to be formed. I've had a few questions about is the probability of a no-deal Brexit on October the 31st essentially zero? Or if it's not, how do you get there? I think it is very close to zero. It could be tested, the legality of the Benn Act could be tested in the courts. I'm not a legal expert, but I haven't seen anything to suggest that the courts would side with the Prime Minister refusing to sign the letter. And there's a very clear mechanism to kick him out in time. So if we get to October the 19th, he's still in position, the European Council meeting has passed, and he's still refusing to write the letter, there's still a week and a half for a no confidence vote to occur. You only need to give a 1 day's notification to the Speaker that you want a no confidence vote. Then it's held the next day. And immediately after that, there's no restriction on how quickly a government can be formed. There may be some, a bit of a standoff between the different parties, and there's some disagreement over who the unity candidate should be. Obviously, Corbyn will put himself forward first, but then there may not be enough support from MPs from other parties to make that happen. But there are other sort of senior Labour figures or ex-Tory figures who could potentially lead that government, which would just be purely designed to send a letter, and then I think would immediately disband and then go to the general election. So I've yet to see any convincing evidence that there really is any way to stop the Benn Act. The Supreme Court judgment from a couple of weeks ago on the prorogation attempt, pretty clearly asserted that they think that the ultimate power here lies with Parliament, and that if Parliament has passed an act, that is what's going to happen. It may be, tactically in Boris Johnson's interest to not sign the letter and be campaigning from outside Number 10. But I don't think that actually will have a big impact on, or any impact on, whether October the 31st is the day of Brexit. I think we can relax and say it's either a Brexit deal, which actually seems very unlikely, or in the most likely cases that we just get a 3-month extension to January the 31st, as is currently written into the Benn Act. I've had a question about if we get a no-deal Brexit, what steps the UK government probably would take to ensure that there wasn't a deep recession. I think it's very clear that the Conservatives, have now torn up their sort of past commitments to fiscal prudence, will spend what they need to try and stabilise the economy. But there's only so much that can be done. I think you can't, shore up the pound. They're not going to be intervening in the FX market. So there will be a big hit to households' real incomes coming down the tracks. And it will require quite a huge fiscal stimulus, I think, to offset what would be a pickup in inflation to close to 4%. There are definitely things that the government could do to try and shore up consumption and confidence. Probably the best way of doing that is just some further big increases in income tax thresholds. But those are sort of permanent measures that are quite expensive. Alternatively, they could go for cutting VAT, but what we've seen in the past is that consumers don't actually see much of the benefit of that. That really gets stuck in the system, and firms absorb the extra take on the saving themselves and not pass it on to consumers. That's what you saw very clearly in 2008 when VAT was cut. So if they're pragmatic, I think they would try and cut direct taxes, and certainly it will be consumption that is needing some stabilization. There are also the sort of practical steps that I think the government can take, but you can't suddenly improve the port infrastructure at Dover to account for all the sort of customs checks that have to be required. There are just disruptions that are going to happen because the government would have had to invest it a lot many months ago to actually fully ward against. Again, there are also things that the government could do to try and stabilize business investments, perhaps bigger capital allowances or further cuts in the main rate of corporation tax. That's certainly something that the Conservatives have been keen on the last few years. But again, given the huge amount of uncertainty that a no-deal Brexit would create, firms wouldn't have any more clarity than they do right now over sort of long-term arrangements with the EU or with other countries. I think capex would be seriously depressed. It'd be very hard for the government to fully stabilize the economy. So, given that the economy is only growing at a sort of 1 to 1.5% year-over-year rate at the moment, it doesn't take much of a shock from here to get into a recession. And I think no-deal Brexit would be big enough for that to actually happen. I've had a question about whether the labour market is starting to weaken. We've certainly seen certain forward-looking indicators suggest that we are going to see a slowdown in employment growth and wage growth. So I haven't got them in this slide pack, but if you look at the latest chart book that we sent out last week, you will see that the job vacancy data really have deteriorated. So this is official data based on job postings. And the deterioration has been quite stark in the last few months. On the basis of past form, you'd be looking at year-over-year growth in employee numbers slowing to zero from near 1% recently. And that might be consistent with a slight rise in the unemployment rate, given that you have generally a growing population and growing workforce population in the UK at the moment. In addition, some forward-looking indicators of wage growth also have softened. So if you look at the proportion of recruiting consultants that say that starting salaries for new hires are rising, you've seen that proportion really fall sharply over the last few months, consistent with wage growth coming down from 4% at the moment to a bit below 3%. So I do think we're going to see a slowdown in income growth, or sort of employment income growth for households over the next year. That said, I think there are some positives for households too. As I've mentioned a few times, fiscal policy is set to be loosened, and I think regardless of which party's in power, we're going to see growth in welfare spending pick up. We're just at the end now of a 4-year freeze on working age benefits that's due to end next year. But also, I think you're likely to see quite big increases in tax thresholds as well for income tax, and that boosting disposable income growth. As I also mentioned, you've got that refinancing of mortgages set to continue over the next year, and that should be providing a decent boost to disposable incomes. Growth in disposable incomes has also been depressed over the last 2 years by the rollout of the sort of workplace pension scheme. You've seen a big increase in the minimum contribution that employees have to make to their workplace pensions in the last couple of years. But now that percentage is set to stabilize into 2020 and 2021. So that drag on disposable income growth, it's been around 0.2 percentage points. It will finally fade away. And also, following the national accounts data that we had out on Monday, households' balance sheets look in a lot better shape than we previously thought. So there's been big upward revision to the estimate of self-employment income. that's meant that incomes have been overall higher than we thought, and therefore the saving rate has been a lot higher. It's now quite close to its long run average levels, suggesting that there is a buffer for households to deplete. If we see a temporary slowdown in income growth, then that won't necessarily feed through one-to-one to spending, because there's a greater buffer of saving now that could potentially be depleted. So in short, yes, I think there are some signs now that the labour market is starting to roll over a bit. It's not going to be a dramatic weakening, but that source of strength for the economy, I think, is now starting to fade. But there are some offsetting positives for households, which should mean that actually growth in spending doesn't slow dramatically. And I've had one question about the impact of all the sort of political scenarios and Brexit outcomes might have on the housing market next year. I mean, it's very clear that, again, Brexit uncertainty has been depressing the housing market this year, with most measures of growth in house prices hovering between 1% and 2% year over year at the moment. You really would have expected in normal times house prices to be growing at sort of 5% rate, at least at the moment, because you've got wages rising at a 4% rate, and you've got mortgage rates falling at the moment. I think we'll likely see a further fall over the next 6 months as lenders pass on the fall in their wholesale funding costs onto households. So we could be looking at, I think, at least another 10 basis point fall in the sort of bog standard mortgage rate. So a 5-year fixed rates with a 75% loan to value ratio, that could fall by a further 10% to about 1.8%. And that would normally be enabling households to borrow more, increasing their leverage and therefore boosting house prices. So that I think there's a very clear evidence again that house price growth is depressed by Brexit. House prices aren't too high relative to incomes because mortgage rates are very low and mortgage terms are very long at the moment. And if you look at the proportion of households' incomes that are being absorbed by monthly repayments, well, that proportion is very, very low by historical standards. And because they're taking out fixed rate mortgages, that we're not going to see any stress in the foreseeable future. So therefore, if there is some resolution on the Brexit front, a soft Brexit or no Brexit at all, then I really think you can see house price growth picking back up again, getting back to sort of 4 to 5% range in 2020. If there were a deal by January, or the very, very good prospect of a deal under a Labour government that was formed at the end of this year. But that's certainly not our base case because it'd take a very big shift in public opinion from where we are right now to actually get to the position where Labour would be in the position to form the next government. As I said, our base case is that hung Parliament and just the fog of uncertainty continuing well into 2020, a no-deal Brexit always being a sort of risk that's around 6 months away. In which case, in that environment, I still think it's quite hard to see the housing market perk up, and that we're likely to see the current 1 to 2% rate of house price growth continue into 2020. I had one question about how the EU might react to sort of further requests by the UK government in 2020 to extend again the Brexit deadline. There may, and that's of course an assumption that I'm making in my my base case of this hung Parliament of rolling uncertainty is that the EU is willing to go along with further Brexit extensions in 2020. Now, of course, there may well be fatigue on their side. They want this done just as much as most people in the UK do. And so it's not a complete given that they'll keep allowing these extensions. But a no-deal Brexit does entail costs for both sides. And so long as there's a possibility of a deal at some point, which is obviously their preferred option, I think they'll be happy to kick the can down the road. Also, as you look into 2020, I can't see any obvious sort of political obstacles for the EU to continue extending. There are no sort of big elections where a leader might be punished for taking a soft stance with Britain. European Parliament elections are out of the way. It's possible that if you had a boisterous UK, that they could cause some disruption in the EU, but realistically, I don't think that's likely. If it's a conservative minority government, then I still think they'll be holding out for some kind of deal. They won't be going all out for no deal, and so they won't be trying to be antagonistic towards the EU. So I think it's reasonable to assume that we will see a Brexit extension again in January if it is a hung parliament, and I think it's more likely that they'd extend for a longer period rather than just the 3-month extension that seems to be on the cards at the moment. That you could get the extension at least to the end of the year being signed off. In which case, that does create a bit of breathing space for firms and for households, and for some recovery, a modest recovery in confidence in the first half of next year. I've been asked on a question about whether there's a big difference in the sort of spending plans for the government, depending upon whether it's the Conservatives or Labour in charge. The answer is yes. I mean, we'd expect an even looser fiscal stance if it was Labour in charge. From what I can see from their proposals, if they're the same as they were in 2017, then they'll be committing to balance the current budgets over the cycle. But that opens up extra scope for borrowing for day-to-day expenditure, given where you think you are in the cycle. It's probably the case that there's a little bit of spare capacity that would open up some scope for borrowing on that basis. But with Labour, it's really that they have pretty bold plans for infrastructure spending. In which case, I think and they're much bolder than the Conservatives. You could certainly see, I think it's about an extra £20 billion extra a year that likely would be spent on public sector infrastructure if it was Labour in power. Now, Conservatives don't have as bold plans as that, from what I can see. But the gap between the two parties isn't as big as you might think now, because the Conservatives almost certainly are going to be tearing up their current fiscal rules whenever they hold the next budget. The budget doesn't seem to be imminent and probably will be held after the next election. But supposing it was the Conservatives were still in power, then they've already broken or on course to break their main fiscal goal, which was to ensure that cyclically adjusted borrowing was below 2% of GDP in 2020. Now, on our current projections, and taking into account some revisions to the accounting treatment of student loans, it looks as if public borrowing is set to be at 2.4% of GDP this year, so above that 2020 threshold. And there is no appetite to have a renewed squeeze in 2020, given the state of the economy. And the fact that they need to try and win over votes. And of course, we've already had the Chancellor earlier last month announcing a big increase in spending for government departments of 12 billion next year, which will ensure it will be ensuring that borrowing is at least at the current levels in 2020. So what I think we're likely to see at the next budget is a shift in the Conservatives' main fiscal goal towards merely targeting a falling debt to GDP ratio. There are other potential rules that they could follow, but that is one that's been mooted in the past, which would open up scope for annual borrowing to rise to about 3% of GDP. So that gives them scope to take borrowing up further from where it is right now, and to therefore implement an overall fiscal boost. And not all of that extra room is going to be taken up by extra government spending. There's also scope for tax cuts within that 3% limit. And I see no reason why they won't get to that limit quite quickly within a couple of years, given that they want to show Brexit as a success, and they may well make some pretty ambitious tax promises in the general election campaign to try and win the election. So actually, we're going to see a fiscal boost come through, I think, regardless of which party wins the election, regardless of the Brexit path. Yes, you would see extra, even an even bigger fiscal boost under Labour's plans, with borrowing probably up to the 4 to 5% level within a couple of years. But the gap between the two parties is not as great as it might appear on the face of it. Okay, I think that's most of the questions. I will just take a look at the chat again, just to make sure that I haven't missed anything, and I'll get back to you if I've missed your question. But I hope that was useful. Please do feel free to get in touch with me via email, shortly after this presentation or throughout the year with questions, and I'll be keeping a very close eye on how things are panning out in the general election that looks set to occur later this year. Thank you.